Portfolio. Collection of investments owned by an investor. Holdings. Contents of a portfolio. Interests. When you get or give a loan, the one who is lending the cash usually wants more cash than what he initially lent. The extra cash that has to be given is called interest. Bond. When an investor gives a loan to a company or a government, the investor earns through interest. Security. Tradable financial instruments such as stocks and bonds. Broker. Since you can't directly go to the stock exchanges to buy stocks, someone will do it for you, usually for a fee. This is called a broker. Nowadays, they are mostly online platforms. Going long. Betting that a company's stock's price will increase so that you can buy low and sell high. Asset. Resource with economic value that someone owns or controls with the expectation that it will provide a future benefit. Commodity. Basic goods interchangeable between producers, such as grains, gold, beef, oil, and natural gas. It usually refers to raw materials. Yield. It's what you earned from an investment. P ratio. The price-to-earnings ratio is one of the most widely used tools that investors and analysts use to determine a stock's valuation. It's one indicator of whether a stock is overvalued or undervalued. However, the PE ratio can mislead investors because past earnings do not guarantee future earnings will be the same. Likewise, projected earnings may not actually happen. Index. It's a method to track the performance of a group of assets. Indexes typically measure the performance of a basket of stocks intended to replicate a certain area of the market. The most famous index is the S&P 500, which tracks the 500 largest U.S. companies.